The market thinks AI could permanently break this business. That's why the stock is now trading at its lowest valuation in more than a decade. Normally when you see charts like these, something has gone seriously wrong. Revenue is collapsing, profits are disappearing, and customers are leaving. But that's not what's happening here. Revenue is still growing and free cash flow is near record levels. The company also continues buying back billions of euros worth of shares. So why has the market become this pessimistic? The answer is AI. Investors are worried that tools like ChatGPT could replace the software millions of doctors, lawyers, and accountants rely on every day. If they're right, today's valuation isn't cheap. It could be a value trap. But if they're wrong, Wolters Kluwer could be one of the most mispriced quality businesses in Europe. So today we're answering one question. Is the market correctly pricing the future or massively overreacting? Let's find out using my 5 key factor framework. If AI is going to permanently damage Wolters Kluwer, this is where it happens. The entire investment case depends on whether customers keep using its software. Morningstar recently downgraded Wolters Kluwer from a wide moat to a narrow moat. Not because the business is struggling today, but because AI creates long-term uncertainty. So is that concern justified? Let's start with healthcare. More than half of US hospital customers have adopted the AI version of UpToDate to help doctors make clinical decisions. Could ChatGPT answer medical questions? Absolutely. Would hospitals trust it with patient care? That's a much bigger question. Doctors don't just buy information, they buy reliability. Decades of peer-reviewed content, regulatory confidence, workflow integration, and institutional trust. That trust has taken decades to build, and accounting tells a similar story. CCH Axcess has become deeply embedded inside accounting firms. Replacing it isn't just installing new software, it means retraining staff, migrating data, and risking compliance failures. And considering these products typically cost less than 1% of a customer's cost base, the savings from switching are tiny compared to the potential downside. Finally, scale. Wolters Kluwer invests over 15% of its revenue back into its products every year. That allows it to continually improve its software while smaller competitors struggle to keep pace. But here's where the story becomes interesting. For the first time, there are genuine AI-native competitors. Companies like OpenEvidence aren't trying to improve the existing model, they're trying to replace it. That doesn't mean the moat disappears tomorrow. But it does mean this is the first meaningful challenge the business has faced in decades, and that's exactly what the market is pricing. Every chart and financial metric in this video comes from Fiscal AI, the platform I use for every stock analysis on this channel. Link in the description for 15% off. Now let's look at the financials. Despite all the AI concerns, the business is still producing excellent returns. Return on invested capital currently sits at 14.2% and importantly, it's improving. That's comfortably above its cost of capital. It isn't quite as efficient as ROIC, but it remains one of the strongest businesses in the sector. Now there's one number that initially looks incredible. Return on equity is over 100%. At first glance, that seems impossible, and here's why. Wolters Kluwer has aggressively repurchased its own shares for years. In 2025 alone, it bought back 1.1 billion euros worth of stock. Shareholders' equity is now only 800 million euros, making return on equity mathematically meaningless. That's why I ignore a return on equity here. Return on invested capital tells the real story. And the real story is that this business still earns attractive returns despite all the headlines around AI. So operationally, very little has actually changed. This is where the investment case becomes more balanced. Historically, Wolters Kluwer has been an impressive compounder. Revenue has grown roughly 4% annually over the last decade. But earnings tell a different story. Net income has compounded at 11.5%. Earnings per share has grown 14.5% annually, helped by consistent buybacks, reducing the share count every single year. That's better than both ROIC and Thomson Reuters. But here's the catch. Analysts now expect earnings per share growth of around 7% annually over the next few years. That's roughly half the company's historical growth rate. The business is still expected to grow, but not at the pace investors became accustomed to over the last decade. And that changes the valuation equation. Premium multiples require premium growth. So when we get to valuation, the question is whether today's multiple already reflects that slowdown and too much AI optimism. One thing the market isn't talking about enough is how much stronger the balance sheet has become. Debt has fallen from 7.7 billion euros to around 5 billion euros in just 1 year. Meanwhile, cash has remained relatively stable at around 900 million euros. Free cash flow reached 1.4 billion euros, giving a free cash flow to total debt ratio of around 28%. That's comfortably above the minimum threshold of 10%. This is also a remarkably predictable business. More than 80% of revenue is recurring. Much of it comes from multi-year subscriptions. That creates highly dependable cash flows. So while this isn't the strongest balance sheet in the industry, it's moving in the right direction. Now we get to the question that probably made you click on this video. Is this actually cheap? Today Wolters Kluwer trades at roughly 10 times earnings. That's the lowest multiple investors have been willing to pay in more than a decade. The historical median was around 23 times, at the peak more than 33 times. That's an extraordinary re-rating. Compared with peers, it's also easily the cheapest company in the group. So should investors simply buy the dip? Not so fast. A low PE ratio only matters if earnings continue growing. Using analyst estimates of roughly 9% long-term earnings per share growth, the price-to-earnings growth ratio comes out at around 1.1. That's not screamingly cheap. It's closer to fair value for a high-quality business. Which brings us back to the question from the beginning. Why has the valuation collapsed? Because the market isn't pricing today's business. It's pricing what this business could look like 10 years from now if AI fundamentally changes professional workflows. That's a huge assumption and one investors need to think carefully about. So let's put everything together through our 5 key factors. The moat still exists, but for the first time, it's facing a genuine long-term challenge. Returns on capital remain strong, growth continues at a slower pace, the balance sheet is improving, and yet the valuation sits at its lowest level in over a decade. That tells me the market isn't worried about today's earnings. It's worried about tomorrow's relevance. Personally, I don't think hospitals abandon trusted clinical software overnight. I don't think accounting firms rip out mission-critical compliance systems because an AI chatbot looks impressive. These industries move slowly, trust takes decades to build. And that's exactly what has protected Wolters Kluwer for years. But the market is asking a fair question. Can the company integrate AI faster than AI disrupts its business? If the answer is yes, today's valuation could look extremely attractive in hindsight. If the answer is no, this decade-low multiple may be entirely justified. And ultimately, that's the question every investor should ask before buying this stock.